All right, well, let's go ahead and get started. I call the meeting to order.
Okay, do the roll call. Herman Covey.
Here.
Stephanie Elliott William. Mark Gardner. Joel Hawkins. David Holly. Landon Moore.
Here.
Patty Phillips. Karen Savage. Catherine Crocker.
Here.
Derek Challenger.
Here.
Andre Stewart.
Here.
Thomas Shanley.
Here.
Brian Birnbaum.
Here.
Where's that year? And did I miss anybody? Okay, we do not have a quorum, but we're going to go ahead and hear all this wonderful material, and it will be online for the other members who would like to watch it, or for anyone who would like to watch it.
Right.
Well, let's roll right into the Greystone presentation.
Well, I think our colleague is dialing in 15 minutes.
Okay, well, we can move
Oh,
on.
okay.
Yeah.
Unless
Do you want to cover the OPEB trust?
Yeah, that's what I was thinking. I attached to your meeting notice a lot of material about the OPEB, the Comerica statements, I think, for August, June, and for the end of September. And that September is the one that's in your package. And you might remember our cost basis that the city has invested is $5,479,890.98. The market value at the end of September was $6,254,422.03. Oh, Mr. Battle.
Still ahead a little bit.
Good morning, everybody.
Morning.
I'm going to mark you here, Mr. Battle. And that is it. There's also material that was sent out regarding the annual report and the investments and the investment strategies and so forth, if you want to take a few minutes with that. But is any questions regarding it?
Did the city make any more contributions to that this year?
It will, yes. It makes it, we do make, it was about $1 million. We continue to budget for it, and we continue to contribute to the OPEB.
Do you recall what the liability is?
The liability last June was 19 million. I do not have the June 22 number yet. That's being worked up. But yeah, that's definitely a deficit.
Does who values the liability for that kind of stuff?
We hire, I believe it's Milliman, who does it for everybody in OPEB. You know, it's a contract through the VML VACO system, and we retain them to prepare that.
Okay. And is that, so that's roughly, I don't know, call it 30-something% funded. Is that sort of typical for cities?
I think it is.
Fund that-
When you consider that the Governmental Accounting Standards Board did not require it to be put on the balance sheet of local governments until several years ago. I can't remember the exact year, but not that long ago. You probably know off the top of your head, Brian.
Yeah, as you look across states and municipalities around the country, most often the retiree medical plans are pay-as-you-go. So the fact that you have some money set aside is great. It's unique across the country. So there's this massive liability around the country and no money set aside to pay for it. You've got some set aside. So while the funding looks low, I'd say you're ahead of the game by the fact that you have some funding set aside for it.
Yeah, this is money put in trust. It doesn't count the couple $1 million the city spends on an ongoing basis today for retiree health care.
That's right, because you're not repaying anything out of you're not using the trust to make any benefit payments yet.
Just put aside.
All right.
Unlike the retirement system where we do draw on it.
Yep. Yep.
Any other questions on the OPEB trust?
And
Nope.
so it's 5 more minutes. Is there anything else we can cover? The reconciliation of market value could be interesting. It's in,
I think Andre put that in his
Yes.
presentation. Do you want to just,
Do you want me to cover that separate from the?
well, I was just trying to use our time. Is there any other topic we could talk about? You know, I think one thing that I wanted to stress is that define the purpose of an actuarial study. I think there's maybe not clarity for a lot of us about what do we do it for.
So an actuarial valuation is done on an annual basis to measure the assets as well as the liabilities in the plan. The liabilities are the present value of all the benefits that are going to be paid to the members, whether they're retired, active, terminated, vested. Those are individuals who have left the employment of the city, not yet commenced the benefits.
Excuse me, can you speak up?
Sure, sorry about that. So we perform a valuation every year to measure the assets as well as the liabilities of the plan. The liabilities are the present value of the benefits that are owed to the members, whether
Into
it's
the future.
Yep, in the future, whether it's retirees who are currently receiving that benefit, active employees, as well as terminated vested participants. The terminated vested members are those who have left the employment of the city but not yet commenced the benefit. So the present value is the single, or the liability is the present value or the single measure, the amount of those benefits that would be due if you were to pay them all today. So we're discounting all those benefits that will be paid in the future with an interest rate, bringing it back to today's value. So we want to understand what the assets are that are backing those liabilities. And what is most critical about the valuation is we determine the actuarially determined contribution, the amount that we're recommending that the city pay into the plan on an annual basis so that there are assets to pay those benefits in future years. You're not going to fund them all today, but if you fund a portion of those benefits every year with some assumed investment return on the assets, that should put the plan in a good position to make good on all of those benefits, 20, 30 years into the future.
So if the value of the assets declines like it is right now, what that means is the city has to put in more each year so that by the time the last person passes away, there was enough money to cover it.
Right. And likewise, on the opposite side, if the value of the assets increase by more than we're expecting, and we have a target investment rate of 7.25%. So anything above that we consider to be an investment gain. Anything below we consider it to be an investment loss. One thing to point out, we use, instead of the market value of assets, we use what's referred to as an actuarial value of assets to determine the contribution. The actuarial value of assets is really the average or smooth value. It defers some of the gains and losses that are yielded every year from an investment perspective. And the idea is to create a smoother pattern of assets that are being used to determine that actuarially determined contribution, and a more predictable pattern of contributions so that the contributions that the city is making is not volatile, spiking up and down every year, but you can budget better for those contributions on an annual basis.
And this is the same method, by the way, that the Virginia retirement system uses for the statewide plan and for what the rest of the city employees participate in. And in Virginia Beach, we had a large actuarial liability, and that just made our rates go up that we paid into VRS each year. So.
And I'll just point out one thing. When we go through the report, you'll see the various measures, both the actuarial value of assets as well as the market value of assets. The actuarial value is what we're using to determine the contributions, but we also report on the market value since that's what you're going to see in the trust.
Right. Thank you. That's.
And about the calculation of the liability, is it, am I right that the sort of the two biggest assumptions into that are just mortality and discount rate?
Correct, correct. And the discount rate is set equal to the assumed rate of return on assets. So that's the rate that we're discounting those benefit payments back to today. And mortality is the other key assumption. We've been actually using the table that is used for corporate plans that's published by the IRS. It's a conservative table. I think it produces a higher liability and a higher contribution. And many years ago, that was the decision that was made, so that the actuarially determined contribution would be a little bit higher than it would be otherwise.
How do you think about how will we think about the population? So mortality being a big sort of driver of liability, is there sort of an inflection point where your population gets so small that that assumption it becomes, I don't know, even less accurate, I guess? You lose the law of large numbers?
You definitely do, and that's with every single assumption that we use. We use assumptions for when participants or when members are going to retire, when they're going to pass away, the mortality assumption, when they're going to terminate prior to taking a benefit, as well as how much their salary is going to increase. And as the population gets smaller and smaller, you're less likely to it's less likely that those assumptions are going to fit the actual patterns of each of those, what we refer to as decrements.
Yeah, so a lot of that's locked in, right? So there's only 14 actives left.
Right. So there used to be a requirement to perform an actuarial experience review to make sure that the assumptions that we're using are consistent with the actual experience we're seeing. As the population became smaller and smaller, there's less credibility to those assumptions. So we could go ahead and do those assumptions, but I likely wouldn't change any. I'm sorry, we could do those experience studies, but I likely would not be able to rely on the information because the population is so small. The data wouldn't really be credible. You need thousands and thousands of exposures in order for the data to be credible.
Thanks.
Sure.
Brian, do you think?
y'all are ready yet?
Well, Jim is dialing in right now.
Okay.
I don't, not our colleague, I would assume, is dialing in.
Zaire,
as well.
what do they have to do? They just dial in? They'll
They
come
already
up.
have the link and everything.
Okay.
Oh, they're dialing in on the video?
Zoom, yeah.
Oh, Zoom, okay.
Yeah.
Get to see people?
Yep.
They,
I'll just give you maybe a little sort of update here. The stock and the bond markets are down significantly this year. And they're both down significantly this year because inflation is high. It's the highest it's been in 40 or 50 years. And in light of that, the Federal Reserve has been increasing interest rates to try to bring inflation down, to slow the economy, to slow demand, to slow, the spending and consumer spending on goods. Anyways, we had a CPI number that came out this morning at 8:30, and it came in lower than expected, which is great news because that's what the market is really hoping for. That's why it's down so much. Inflation's been higher than expected. The futures market for the Dow is all I have, is up over 600 points today. So this is what the Fed's been trying to do. It's starting. I mean, it's one one data point, right? But it's starting to get traction. And once it becomes clear that the Fed has got a handle on inflation, we would expect to see days like this.
what did inflation peak near like 9%?
9.1 was the high.
Mm-hmm.
So now it's, I don't know what the 12-month number was, but the inflation number for last month was up 0.4%, and the expectation was 0.6%. So I would suspect the 12-month number is the first number is a 7 instead of an 8, which has been great. Jim, do you know what the 12-month number was?
The nominal CPI was 7.7, and the core, which just came out, was 6.3. So that's below the previous 6.6, which was the last high water mark from 1982.
great. So hard to say inflation of 6 or 7% is good news, but in this environment, it's good news.
It's less bad.
There you go.
Everything is relative in this
Indeed
business,
it is.
right?
Yeah. So Jim, we're still waiting. Oh, it looks like Dan is dialing in right now.
Dan's connecting, and while I'm sorry I'm a little late, I had a little bit of a family emergency today. But the market really liked the inflation numbers this morning. Dow rallied about 600 points right after the news.
Good.
But this is the perfect time to introduce Dan.
How do we get him? If he talks, I think he'll pop up.
Hey, Dan, can you hear us?
You should be able to. Let's see. Turn your computer speakers on.
It is.
Can you guys hear me?
We can now. Perfect.
Yes.
Okay, I can hear you.
Good.
Dan Shelley.
So Dan is a member of our global investment office team who spends his days looking at all things market related. And instead of hearing from Jim and I about kind of how we see what's going on in the markets and the world unfolding, we thought we'd have Dan come and talk to this group. So Dan, without further ado, I'm going to turn it over to you.
Thanks for having me. My pleasure. And good morning, everyone. Just very, very timely. We're talking. The futures are up aggressively on the back of slower inflation data this morning. So very important data point just 20 minutes ago. So listen, what I thought I would do is maybe start with a 10-15-minute update in terms of what we're seeing from a macro standpoint within the economy and the markets as a whole, and then I'd love to leave just ample time to hear your questions and feedback and make this as interactive as possible. So just to kind of rewind the clock for a minute, I always think it's important to consider where we've been before we predict where we're going. And as you all know, where we've been the last year, the last 2 years, really since COVID, has been nothing short of extraordinary. We've been moving through lightning speed time in terms of the phases of this cycle. And, when you think about it, every phase of this economic environment has played out in record speed. The latest of which has really been all about the Fed pivot and the realization, starting, I would say, a year ago, that inflation was going to be higher and more persistent than many had thought. And maybe with this morning's news, we're maybe getting to the other side of that arc. But nonetheless, when you go back to the fall of 21, there was one Fed rate hike priced for this year. And of course, now we've gone through a series of 475 basis point hikes in a row. And we've had an incredible move, obviously, in rates, a move in volatility, incredible move in stocks. And it's obviously been a brutal environment for the traditional 60-40 type portfolio, second worst on record in the last 40 or 50 years. And listen, I would say we don't get a recall right at Morgan Stanley. No one does on the street, obviously. But I've been here 17 years now, and when I look back over the calls in the last 2.5 years, really starting with COVID, we really have gone 3 for 3 in terms of the calls that truly mattered. Number one, being aggressive during COVID, buying into the crash, adding to stocks, adding to high yield. Number two, we as a firm were more concerned about inflation way ahead of the Fed and way ahead of Powell. We were warning about inflation in the spring of 21. And if you're worried about inflation and you're early, you're obviously worried that rates could reprice higher. And if you're worried about rates repricing higher, as was our call, the S&P 500 has a growth, long duration skew towards it that's really evolved over the last decade, the last 15 years. And so, of course, that's been the cohort of equities that's led on the way down this last, call it 9 or 10 months of this bear market. And so we were, as I joke and James knows, we were on a bit of a lonely island a year ago from our strategy call warning about a defensive stance, a bear market. And of course, that island's become a lot more crowded in the last couple of months in terms of negative sentiment. Any way you cut it, whether it's mutual fund cash positions at 10-year highs, hedge fund net exposures at 15-year lows, retail bearish sentiment extremely high. Almost every sector of the world is doom and gloom, and that's why you're going to see a very vicious rally this morning in terms of that inflation data point. I can come back to that. And so, look, we've really outlined this year as expecting a twofold bear market. The first starting with, obviously, rates and multiples derating. And we saw that. The S&P came down from 21 times in January to, call it 15 times at the June and October lows. And the second phase, we think we're really kind of in the thrust of that now, which is the growth slowdown. And the question, I guess, on everyone's mind, including ours, is how big a magnitude of a growth slowdown will we see? And I think the answer is, look, we're going to see the economy slow, the consumer slow. The tightening is already having effects on very rate-sensitive parts of the economy, i.e. housing. We're going to see earnings come down. We've said this for the last 6 months. Earnings are just too high in terms of the expectations for 2023. I think starting the year and then stubbornly over the course of the year, they've been around +7%, +8%. For next year, we think that'll be closer to flattish. So that still needs to come down. But on the more positive side of things, there are times where the markets and the economy really kind of go together and they're perfectly aligned, and there are times where they diverge a bit. And I think most people don't recognize that that this is actually one of those times. In terms of the broader kind of general economic picture, at least as it pertains to the U.S., I think you could certainly argue there are other issues in Europe, other issues in China, and ex-U.S. But as it pertains to the U.S., the job market continues to be fairly resilient, fairly strong. Credit continues to be, a fairly bright spot. I think if we were going into a much more draconian economic environment, credit spreads would be telling you that, and they're just not. Credit spreads are acting very kind of well-behaved, very benign on the investment grade, on the high yield side. And, look, the last part of the story is this morning's news about inflation. And in the last 15 minutes, I haven't had time to go through all the details, but our team at the firm was predicting the start of a slowdown in inflation month over month, primarily driven by rents slowing a bit, medical insurance costs, which have been kind of anomalously high, slowing, car prices starting to slow, both on the used and the new car price spectrum. And as many of you probably know, and if you've tried to get a car in the last 2 years, you certainly know that supply has been incredibly lacking due to all the different chips and supply chain issues emanating out of Asia. But the reality is China started reopening in earnest in June. It's been in fits and starts. But you're seeing everyone, chip companies, car companies, everyone comment that we're seeing easing of supply chain pressures. So cars are becoming more available and prices therefore are going down. And so the net effect of all that, folks, is that inflation is finally starting to slow month over month. And at the same time, we're in very kind of uncharted territory as it pertains to obviously China policy and lockdowns, Ukraine war, structural labor issues. Look, there was a labor shortage, and in particular a skills shortage prior to COVID, and that's only gotten worse since COVID. There's an estimate 3 million people retired early in the last 2.5 years. They're not coming back. And so the net effect of that kind of landscape is that we're not going to nosedive here to 2% magical number in inflation at any time in the foreseeable future, but nor are we going to kind of repeat the 8-9% extreme numbers that we've seen in the last year, as this morning's data illustrates. And so, look, we're probably going to land in a bit of a higher level, call it 3, maybe 4%. And so that kind of keeps the Fed involved, but at much less increments, right? And so that's, I think, an important takeaway for the market to see is that the Fed, which obviously has been playing dramatic catch-up after staying on the stimulus train way too long, is now at a point where it can finally, hopefully, step its hikes down. So we're expecting 50 in December. We're expecting 25 in January, and that's it, finito. And it's, the very last thing I'll say is, look, it's important because the equity market, obviously I'm in equity, portfolio manager, the equity market has taken a lot of its cues from the rates market and the bond market this year, as we've described, with this dramatic move up in rates. And I think we're getting to a point where the Fed is getting to be more priced by the equity market. And one very simplistic way of thinking about that is, today the market, after this morning's bounce, will be certainly 3% higher, but let's just say versus June lows in the middle of June, which was 36.66, we were about 3% higher as of yesterday on the S&P. And so you would have said, well, hey, the market's been so focused on the Fed and tightening, maybe the bond market or maybe interest rates are around the same level as they were in June, or maybe even lower, if that's the case, that the stock market's a bit higher. And the interesting nuance is that the bond market, at least as of yesterday, was 70 basis points higher than it was in June. And so what does that tell me? That tells me that, again, we're getting closer to a point where Fed funds terminal expectations are becoming more, I would say, reasonably priced. And if the summer kind of bear market rally head fake from June to August was all about the market being preemptive and too anticipatory of a Fed pivot, which was Jackson Hole's kind of knockout punch from Powell and led to the August to October sell-off, that was at a different point in time. The terminal rate expectation from the market then was 3.5, 4. Now that number is closer to 5. Okay, so we're at a different point. And the very last thing I'll say to conclude this entire summary is, look, if we're at a point where the Fed is becoming more reasonably priced and we can kind of move beyond macro factors driving everything, that's a very good environment for asset allocation, for active managers. You would assume this year was a bonanza year for active managers, and frankly, it wasn't. There's been very tight correlations, very little dispersion. And so I think we're moving into the next phase of this where you can really separate winners from losers and be active. And from a positioning standpoint, we have said to folks, look, there's a couple of things to think about at the moment. The market has taken so much from us this year, including a little bit of our sanity. But one thing it is handing us at the moment is yield. Okay, it is handing us yields that we have not seen in a 15-year time period. And so whether that's high quality investment grade credit, where you can clip 4.5%, 5%, whether that's part of the dividend equity landscape. And look, dividend equities and value equities have done way better than growth and way better than the S&P this year. But in many cases, there's some really good dividend names that are down 10% plus. So that's another area that we're fishing in. And then last but not least, next year may be a year where you want to play some reversals. And so just to put this on the radar, nothing to do, I think, at the moment, but the reversals we're tracking are, number one, thinking about emerging markets. That's been a very tough spot this year. We think there could be some catalysts on the horizon, including a more aggressive China reopening next spring that maybe leads to better EM performance. We think the dollar, which, by the way, over the last month has been slowly rolling over, and the dollar was basically telling you the inflation print was slowing today. It's one of the really, really fun parts of the job is kind of looking back and trying to recognize who knew what. And so interestingly, the currency market, which is one of the most liquid markets and efficient markets in the world, was basically predicting a slowing in inflation because the dollar's been making lower lows for the last month or so after having an extreme move for 12 months. So weaker dollar could be positive for EM. These are some of the things we're tracking. And then lastly, growth stocks. As I mentioned earlier, growth has led on the way down over the course of 9 or 10 months. It's had an epic bear market. There will be a time to add to growth again. We don't think we're there yet. We probably want to see a more explicit Fed pause versus just an incremental step down in rate hike increments. And we think that's potentially 1Q or 2Q of next year. And within growth, we want to think about being very active and not just favoring the old growth leadership. The old growth leadership in terms of Mega Fang was all about consumer applications of technology across mobility, social media, e-commerce, online advertising. And look, many of those are still great businesses, but let's not forget they're huge market caps. And anytime you get to be huge, the law of large number augurs that you may not repeat the magnitude of performance going forward. And number two, anytime you're that big, you're in the eyes of the government. And so we think a lot of those business models are going to go through a lot more scrutiny in the coming years. And so the quick takeaway is think about the next types of things. Think about where innovation and technology is driving over the next decade. And for us, it's not as much about the consumer use of technology, it's about the industrial application of technology. And so when you look at all sectors, be it financials, healthcare, industrial manufacturing, you name it, we're looking very closely at companies that utilize technology to become more productive, to grow margins, that utilize, again, the newer innovations, AI, big data, automation. These are the innovations of tomorrow. And look, as I mentioned earlier, if we land at a 3-4% new inflation kind of step function level, having some data and technology advantages will probably lead to pricing, and having pricing will be a huge differentiator in a new type of inflationary type backdrop. So with that summary, let me turn it back and see what you're all focused on.
I can break the ice with a question. Regarding the Fed, next year, are people going to be more concerned with the Fed sort of potential pivot or earnings?
Yeah, that's an excellent question. And look, we thought this year was really about the Fed, and most articulated or most expressed by the change in multiples. So, going back a year now, thinking about the 2-year tripling, the 10-year doubling, we've seen the S&P PE multiple come from 21 times in January to 15 times at the lows. Let's call it a 30% plus derating in multiples. So we think the Fed kind of hysteria has played out to the downside this year. I think your point is a really crucial point for next year, as you mentioned, which is all about if the Fed is slowing now in terms of its rate of tightening and maybe even pauses at some point next year, is that kind of like the catalyst that drives the sustained bull rally? Or, as you mentioned, are earnings and growth going to be kind of a bigger part of the equation impeding that sustained rally? And, the reality is we're more on the latter side of things. Okay, so as a team, we think that earnings, particularly in the January and February reporting period, where companies announce their 2023 forward full year guidance, which really hasn't happened yet, we think that's kind of the last shoe to drop, right? So, and like I said earlier, it's probably not a incredibly draconian scenario where earnings need to fall 20, 30%. It's more along the lines of maybe 5, 10%, but that's really not as priced in today. So investors are still waiting for the managements to kind of hand them the engraved invitation. So you'll probably see, some continued volatility, but then you're getting to a point in the first quarter, maybe the second quarter, where the Fed's out of the way and the earnings reset has happened, and maybe that sets the stage for a more sustainable move.
So maybe the sort of the worst news on earnings we could get in the first quarter. The Fed's not going to be fighting the market anymore. Are y'all thinking second half of next year the Fed's going to pause, or are you in the potentially cut camp?
More of a pause. So our official numbers right now are pause. And I think the reason for which is, the Fed's going to kind of wait and see what happens with the economy and with jobs. Now, listen, like I described earlier, jobs have been incredibly resilient and I think have surprised many. For what it's worth, I personally have not been as surprised by it because I kind of look at things from a company and bottom-up perspective. And one of the things that I believe is underestimated by many is this kind of normalization of the workforce post-COVID. I mentioned earlier that 3 million people have retired and are not coming back. And so, good for them. They're working on their handicap. They're getting a tan, family time, great. At the same time, however, there's something like 2 million people who did leave the workforce voluntarily during COVID who had some type of specific issue. They had to take care of a family member. They were preconditioned, fearful of COVID. There was a tremendous amount of lack of immigration hiring because of travel restrictions during COVID. So at the same time that we've had this kind of structural impediment to the labor supply, I think one of the reasons we've seen such near-term improvement is just the people coming back to the workforce who voluntarily left, all right? And so that's kind of helped buffer the job market, the consumer spending trend, and therefore the economy. So the question is, how long does that last? And the other question is, look, in terms of parts of the economy that, admittedly overhired in the tech world and the growth parts of the world, they're now cutting back more substantially, all right, along with a marquee internet name just this week. And so, the question is, at what point does the job market kind of flatten out or even turn south? And I think we have to keep watching that trend in order to answer your question in terms of whether it will be just a pause or cutting rates. For what it's worth, the market stubbornly still thinks that the Fed will be cutting by the end of next year. We're not quite there yet.
Thanks.
Counsel.
Current events and the recent laying off of tech employees. Now we know that the economy is out of whack. It's not balanced as it usually is, and that's the main problem that we're having. This sector is expensive. It bothers this one, is losing, and so forth. But recently, Facebook and Twitter laid off a number of people in the thousands, and the ILA have reduced the wages of all of its employees who were making $30, $40, $50 an hour. They're in contract negotiations, and the outcome that's desired by the business is $18 to $20 an hour. So having the instability of all the different groups, having the autonomy that they have, with nobody at this point that can rein them all in, we're looking at a possible shipwreck. Are we not?
Just the last part was a possible what?
Shipwreck.
Yeah, and listen, I think that's fair. And when you look at the numbers, Facebook and Amazon, all these kind of big platforms, they had this tremendous bonanza via COVID, right? And so, like, perversely, all we could do was watch movies on Netflix and order more Amazon stuff than you could shake a stick at. And I always joke with my wife, like, maybe one day one of those boxes will have my name on it, and really never does. But the reality is that kind of year-and-a-half period was incredibly beneficial to those companies. They saw their earnings power and their market share step function jump forward 4 to 5 years, right? There's one data point that I think really beautifully illustrates this as a microcosm, is that Amazon's percent of e-commerce as a percent of total retail, they gained like 4 years of market share during COVID. That's all we could do was order Amazon. So what did they do in response? They did the same thing that aggressive managers do, is they overhired. Okay, so they overhired, they overexpanded. So they're giving a bit of that back at the moment. And so I think the broader takeaway or the broader impact is, yes, it's a shipwreck within certain companies, and they're big employers, and those people are high paid. So no doubt that will have an impact. But you're really not seeing that broad trend pervasive across all industries, right? So you're seeing some hiring slow down, no doubt, but you're not seeing those broad cuts in the workforce. And I'll just give you one quick anecdote. I was at a dinner a few weeks ago with an analyst who covers industrial companies, so HVAC, construction, you name it. And he said the CEO said, "Look, we don't have enough people to fire. We don't have enough inventory to slash." That's a pretty odd comment amid a growth slowdown, but it is one that is a function of the nuanced in incredibly unprecedented times we're working within post-COVID, right? So like there are a lot of companies who look at their existing workforce and they don't know if they're going to be able to find workers on the other side of this slowdown. So they're not really firing in mass. And as I mentioned earlier, this is the biggest issue that will be frankly, I think could be post the election. This could be one of the biggest bipartisan initiatives that this country ever sees. But the skills gap in this country is incredibly wide. The good news is for those folks who are leaving tech companies, they're in the sweet spot of the skills kind of spectrum. And so, I have no doubt that they're not going to be people who permanently leave the workforce. They'll get picked up in various industries going forward.
They say that most of the businesses are quietly retracting, and as to not cause a panic. And they said that the futurists say that the tumbling has only just begun.
Yeah, I mean, I think you're seeing the tech companies give back, particularly the housing area, give back. But once again, like housing was an area where, if you were a real estate broker in a suburban, name your suburban part of a major suburban part of the city, probably had your record earnings in the last couple of years. And so, I'm not trying to downplay the slowdown, but I think it's going to be kind of more contained than seeing this kind of broad, widespread workforce reduction. Look, the Fed has talked about the fact that they're trying to narrow the 10 or 11 million jobs available with the number of job seekers. They're trying to narrow that number. But I think as this morning's data shows, wages and labor is one part of it, but there's kind of a multitude of inputs that have gone into this extreme high inflation. And if we're getting to a point now where the Fed is going to slow its rate of tightening, I think that probably does limit the economic impact, and therefore does limit the amount of additional layoffs and workforce reduction.
But they're saying it could be chaos when those wealthy folk are quietly pulling their money in, and when those companies, you have a lot of companies to go out of business, that's what they say that they're pulling their monies in for, to expand their empires, so to say. And a lot of businesses, small businesses, medium-sized businesses will be fading and will have to succumb to those billionaires and kind of throw things off quite a bit.
So, do you have a question as well, or is it more of just a comment?
A question. So that's what they're saying. What is your response to that? How do we survive that?
So if I understand the question, you're talking about the fact that if wealthy individuals either shutter businesses or pull their money out of markets, that'll lead to a bigger correction or a bigger recession. Is that what you're...
Right. Possibly a depression.
Yeah. No, listen, I think that's a fair...
Because we're in a recession at this point.
Yeah. So listen, I'll say two things, right? So the first is, having a company perspective that I do, I look at this trend very closely, and it's kind of best described by companies, right? So like, as an example, American Express a few weeks ago, which kind of caters to the wealthy, reported record travel bookings, record corporate bookings, in pretty good spendings and very low credit and delinquency type figures, which is reflective of that income bracket. At the same time, the airline companies, whether you're United, Delta, American, all the airlines were saying record business. And so what all that's reflecting is kind of two things. One is that there's a big rotation going on at the moment. That anyone who does have discretionary income, and to your point, in many cases, the higher income kind of cohorts of society, they're moving from the Netflix like home improvement binge of 2020 to the travel binge. And so this is actually a good thing, because the service industry actually employs more people than the goods industry. Okay, and so we have navigated to a services type economy in the last 30 years, and more of our economy and more employment is driven by service. And so, you know, and on the goods way of looking at things, look at this. You know, 30% of US GDP in 1982 was manufacturing. Today that's 12%. So we're kind of tied to goods and manufacturing production that we once were. So in a way, I can actually spin it kind of positively, that we're seeing people with money allocate towards services, because that may keep employment up in those areas, right? And when you look at what happened in COVID, the second thing I'll say is that it was sadly and unfortunately very much a 99% recession, right? So hotels, restaurants, services were shut down, and so the employment in that sector got hurt the most. And there is today, even with this dramatic 4 million job creation over the last 9 months, there's something like a 1 million deficit still in services. I mean, I don't know if anyone's traveled recently, but it is not necessarily fully staffed. And so the reason I mention all this is that I actually think this rotation within the economy might actually portend a better economic outcome than we're thinking about. Because I think it'll keep service workers employed for longer. And then the very last thing I'll say is, look, it's all about starting point. Like, yes, maybe some richer people will take fewer trips, but let's keep in mind that prior to this year, they made money in markets for 10, 15 years, extreme money. They made money in the last couple of years in housing, and their home equity jumping record levels in the last 2 years. Slowing a bit now, of course, but that's off of a very high level. So their wealth effect is extreme, and they didn't lose work like the hotel and restaurant were during COVID. They could Zoom from home, they could work from home. And so, listen, the reality is 2/3 or so of spending in this economy is from the wealthier cohorts. So yes, they are seeing some pain on the margin, no doubt, but the starting point is much higher. The wealth effect is still very strong, and their focus right now on services could be better for middle-income service workers.
I am not a negative person. I have always taken lemonade, and lemons have made lemonade. And all I'm saying is, are we prepared to cope with what is coming in the future? Because again, we've made quite a large loan to make this system solvent, and the city can't take back-to-back, loans out like that. So again, I'm not a negative person, and whatever I see, again, if it's lemons, I'm going to turn it into lemonades, and I hope you have your plans to keep us sweet as well.
Yeah, I think that's really well said. And listen, with the damage in the bond and stock market this year, we've been throwing a lot of tomatoes, right? Like, hasn't even been a lemon type scenario. And so our starting point today, mathematically, fundamentally, is better than it was a year ago, no doubt. Bear markets happen, we're going through one right now. But at the same time, right, let's not just extrapolate my summary to be that I'm a raging bull either. I think one of the actionable takeaways I mentioned at the end was to consider parts of credit and income right now. And so we're still saying, look, all the points you raised are totally valid. It's still a somewhat uncertain environment, albeit values have corrected meaningfully. But from that more conservative process, let's look at just finding some income where we can today and being more conservative. And I believe, knowing James, knowing your team, that's pretty much how they've looked at your plan over the long term.
Thank you.
My pleasure. Any other topics or questions?
This is one of those things we could talk for hours on.
Yeah,
But it was
no doubt. And I have my next client call in 9 minutes, so I do get to talk.
Okay,
Thanks for your time, Dan.
thank you.
Thank you all. Best for the holidays.
Many thanks, Dan.
Pleasure.
Okay.
So the takeaway, buy some bonds.
And we have been.
All right.
There's your, there you go.
What would you like to do in terms of the rest of the meeting? I know Andre's got a lot of stuff to talk about. We still have the report. Do you want us to continue? Do you want to go to Andre so we get that in?
I was going to say, can we just do a quick portfolio update and
Yeah,
then
sure.
move to Andre?
Sure.
Is that?
Jim, is that good?
Yep, works great.
Okay. Maybe where I'll start is on page 2 of the report.
His report is
The bound
with the,
report.
With the spiral bound finding.
City of Portsmouth Q3 2022 review. So here's the returns of the major capital markets, both stock and bond indices. We show it for the third quarter, year-to-date, and longer-term periods. I'm not going to harp on the numbers. You know what they are. Third quarter, equity markets were down 5. Bond markets were down a similar amount. Year-to-date through September. Now, things are a little different now because October was such a strong month, but year-to-date through September, equity markets were down 24, 25. The bond market was down 15 or so. If you put that into a little bit of historical context, we are in the midst of one of the worst years in the history of the stock market. You go back to 1928, there's only been 5 worse returns, 3 of which were during the Great Depression. One was in 1974, and the other one was at the start of the global financial crisis. If you looked at the bond market, it is the worst return in the history of the bond market. In fact, the 100-year flood in the bond market prior to this year was 1994. The bond market was down about 3 or 4% in 94. We're down about 15% this year. What I think is unique about this year relative to history is the fact that both markets, both stock and bond markets, are down in tandem, and they're down to as a significant degree as they are. In the interest of time, I want to kind of flip through some of this stuff relatively quickly. I'm happy to spend more time. On page 4,
Brian, are we looking at the bound one or the
bound report, yeah, the
Supplemental.
bound report. On page 4, this is a list of all the things we've done this year. So markets have been volatile. We haven't been sitting by. We've been very active trying to position the portfolio in a way to protect capital and ultimately to take advantage of opportunities once we get through the negative environment that we're in. And if I were to just kind of broadly characterize the actions we've taken, I would use the term we've de-risked. What does that mean? We've sold stocks, we've reduced our equity exposure. In some sense, this is a form of de-risking. We've increased our use of passive management. We can talk more about that. The problem was there really was nowhere to go. Because if you sell stocks and you buy bonds, you're down about the same amount anyways. So diversification has not worked in 2022. In fact, if you looked at, everybody talks about this 60-40 portfolio. 60-40 stock and bond portfolio is being kind of roughly in line with how investors invest their assets. The 60-40 portfolio is down about 17% this year. That is the worst return for a diversified portfolio in 100 years. So again, it gives you the sense of the sort of unusual times that we're in. I think it's important, though, to keep in mind that the returns up to this year had been so strong. Last year, stocks were up 28, 29%. The years prior, the market was quite strong, both the stock and the bond market. So although we're down significantly and it hurts, the long term we've participated and we've made money, and we're giving some of it back. Yes, we've tried to de-risk. There hasn't been anywhere to go. It seems like with the data today and what Dan's talking about, we're getting closer to the end of the environment that we're living through right now. On page 8, I'll just kind of show you the returns here. We actually held up a little bit better than the benchmark in the third quarter. We're down about 5.6% in the third quarter. Our benchmark was down about 5.8%. But for the year, we're down 23, and we're behind our benchmark. The reason we're behind our benchmark is because the active managers we thought that were going to hold up better in this environment that we're living through haven't lived up to their end of the bargain. And if there's anything that's been surprising or disappointing to us, it's the fact that active managers who historically provide protection in down markets have not this time around. There's, again, I want to be sort of cognizant of everybody's time. Mr. Chair, I'm happy to go anywhere you'd like. If this is sufficient, fine. I'm happy to answer any questions that you may have. Maybe just real quick, just to show you on page 9. I told you we've been very active and we've de-risked the portfolio. Our target allocation to stocks is 70%. As of the end of September, we're about 5 percentage points underweight that target. Not a huge bet, but a bet nonetheless. We are underweight stocks. Again, we're overweight bonds, and bonds have been down about as much as stocks have been. So that relative positioning hasn't helped much. We do think as we get through this Fed tightening cycle that positioning will start to help us out. As Dan talked about, bonds are a pretty darn good place to be looking to generate some returns these days, and we're positioned in that fashion. Where would you like to go next, Landon? Or any questions or anybody?
Hey,
Yeah.
hey, Brian, you want to just review slide 3 for a moment? I think it's quite interesting.
Oh, yeah.
From a manager perspective.
So I mentioned the thing that we're a little bit, well, more than a little bit, but disappointed about is the fact that active managers haven't been able to protect capital in this drawdown that we're living through. And the reason for that is because of the kinds of managers that we invest with over the long run. Now, what do I mean by that? Over a long period of time, when you invest in good companies that have strong balance sheets, that have strong brands in the marketplace, whatever industry they're in. Think companies like Coca-Cola or Microsoft in the technology sector. It's good companies who have products that are in high demand, that have pricing power in an inflationary environment. Those companies are often referred to as quality companies. Now, it sounds counterintuitive you would invest in anything other than a quality company, but as a practical matter, this year, this quality factor, as it's referred to, has been one of the worst returning parts of the market in the US and overseas. So this feature of what works over the long runs and the kinds of companies you want to own has been a disaster this year. And that's why active managers, maybe relative to other periods where there's been significant market declines, haven't kept up with their indices, because that quality factor in the past has worked really well in these kinds of environments. It hasn't been working this year. So that's what's driving the active management performance, which is why we underperformed for the year. We had significant excess returns built up in the plan here in the early years of our relationship. We're eating through those this year, but we feel very good about where we're positioned. the companies and the bonds that we own, and what appears to be sort of a bottoming out of what the Fed is doing to get a hold of inflation. Feel very good about how the portfolio is positioned today.
Anyone have any questions for Brian before we turn it over to John Hancock?
It's just unsettled times when you're hearing the best of the bad news.
It's just, yeah.
So nothing from 1 year to the left is positive.
Correct. If you looked at the stock, the only sector, well, there's a couple of sectors, but the biggest one everybody talks about that is positive this year are energy stocks. Energy stocks are up about 60% this year, positive.
I see, yeah. I see.
Energy stocks are about, they started the year at about 3% of the index. It's a tiny piece of the broad economy, but it's one of the only things that's doing well. The other kinds of companies that are doing well, and this is important for this area of the country, defense stocks. Defense stocks have done reasonably well too. But everything else is down, and everything else is down significantly.
Pretty grim.
Yes, but this too shall pass. We're getting, there are periods that we experience. In fact, if there's in the handout packet titled Market Update Q3 2022, on page 6, there's a chart here starting in sort of the 1930s, and it maps out the bull and bear markets in U.S. equities, the red being bear markets. You can see they happen. You can see they happen relatively frequently. But the thing I take away from this chart is that the declines are significant, but the period of time they last are pretty short. In fact, if you looked at the average length of a bear market since 1932, it's about 16 months. We're about 10 months into it right now. And when Dan talked about things sort of bottoming out, and maybe the spring of next year, maybe the first half of next year, it looks like sort of the typical bear market. The declines in a typical bear market where we don't have a recession on average are down about 26%. The end of September, we're down 25%. When you have a recession, declines are typically down about 34%. So we think there's potentially some further downside here, but we're not talking about the kinds of declines that we've experienced during the Great Depression. The economy is in too strong of a shape these days. The financial system's in very good shape these days, where we don't expect to see those kinds of declines.
What was the peak? Was it in January?
Of the stock market? Yeah. Yep.
January 4th.
Yep. Very, very early.
Yeah.
Which index was January?
Happy.
Yeah, right. Happy New Year?
Peak January 4th. Happy New Year.
Yeah. So it's difficult, it's painful, and we don't want to, to diminish that, but this too shall pass. We will get through it. Things will get back to some semblance of normalcy.
Long-term view.
That's right.
I guess the difference is in some of these bear markets, the bond market didn't.
And that's the really hard
didn't
part
get hit
this
on
year.
both sides.
That's right.
Yet.
Like during the COVID blip here, which is barely even a red line.
That's right.
It was great to have bonds.
That's right. If you go back to 1928, when the stock market is negative in a calendar year, the bond market is negative 20%, less than 20% of the time. So 1 in 5 times when the stock market is negative, the bond market is negative. We're in one of those 1 out of 5 times. And that's why the diversified portfolio having the worst return in 100 years, that's why you get those kinds of numbers.
All right, well, thank you
Sure.
for the update. Yeah, I mean, the only thing I can say is hopefully we have a better year next year.
I hear you. I hear you.
And that we're not stuck in this sort of quagmire for much longer.
Yep.
All right. Who wants to go first? Is it?
I think it's me.
All right, Andre.
Thank you, Landon. So I'm going to be covering the information in this packet with the paperclip. And we can get started on page 4 with a brief summary of the provisions of the systems. The benefits are provided to members upon 3 different triggers. One is retirement, the other is disability, and upon death, benefits are paid out to members. The next slide. The eligibility for members of the fire and police system, eligibility for retirement, is upon 20 years or the attainment of age 50 with 5 years of service. The benefit is based on a combination of compensation as well as service. So for each year of service, a member accrues, at least in the first 20 years, they accrue 3% of compensation, of their final average compensation. Final average compensation is equal to the average of the 36-month high of their compensation. So for the first 20 years, it's 3% of that number. The next 10 years, or next 5 years, it's 2%, and thereafter it's 1%. So after 25 years of service, 70% of compensation is replaced in retirement. Members of the fire and police system also receive a $200 supplement until the age of 65. So if anyone retires prior to 65, until that age of 65, they will receive an additional $200 per month on top of their monthly accrued benefit.
Could you actually get more than your final average compensation?
Depending on how long you work.
Work 56 years or something?
Yeah, depending on how.
You make more money by retiring?
Absolutely.
Interesting.
The most I'm aware of is 48.
48 is the longest tenure?
Yes.
Yeah. Nobody works that long, especially in police and fire. That's a strenuous work. Unless you're going to set the record, I don't know.
No, ma'am, I thank you for that, but I'm not going to. But we did have one sergeant who retired with a total of 48.
It's pretty impressive.
Pretty hefty benefit. Well deserved. On page 6, a summary of the benefits that are accrued in the supplemental system. First, the eligibility for retirement is age 50 with 5 years of service. Similarly, the benefit is based on the final average compensation. In this scenario, it's a flat 2% is earned for each year of service, regardless of the number of years that are worked. So after 25 years of service, instead of receiving 75% of your compensation, supplemental system will replace 50% of compensation. Supplemental system members also receive the $200 supplement until age 65 if they retire prior to that age. Just want to quickly touch on some of the terms we'll be utilizing throughout this review. We already talked about the actuarial value of assets, and we're on page 8 now. Just again, the actuarial value of assets is a smooth value that averages the market value over the past 5 years, intended to smooth out any volatility and create a more predictable pattern of contributions. The actuarial accrued liability is the present value of benefits that are due to be paid in future years. So if you were theoretically wanted to settle those liabilities, this is the value that would, or the amount that would be due. The unfunded liability is just the difference between those two measures. How much does the liability exceed the assets by? The funded status is another way of looking at the health of the financial health of the plan. It's a percentage, divide the assets by the liability. So we look at both of those measures because you want to have an accurate picture of that unfunded liability. And then the actuarially determined contribution, that is really the crux of the valuation that we perform every year. It's it's the amount that, from an actuarial perspective, that we're recommending that the city contribute to the systems on an annual basis. So how do we determine that actuarially determined contribution? There are two components of it. One is the normal contribution, which is the present value of benefits that are being earned in the upcoming year. Someone referenced earlier the number of active members in the plan. There's only 14 active members across the two systems. So that number, the normal contribution, is very small in relation to the total contribution. What the contribution is primarily comprised of is the accrued liability contribution. And that's an amortization of that unfunded liability. So an amortization is similar to a mortgage payment. You get X number of years to pay off that debt. Similarly, we get X number of years to pay off that unfunded liability. For 2022, that number is 14 years, so the unfunded liability is amortized over a 14-year period. Questions or comments? As Landon mentioned earlier, the two key assumptions that drive both the valuation and the contribution are the interest rate, which I mentioned is pegged to the assumed rate of return, which is 7.25%, as well as the mortality table. As far as we know, there's no cost of living adjustment for the 2022 or the fiscal year ending 2023, so we have not reflected that in these results. So always start with, on page 10, a summary. And I'm doing something a little bit different this year, I should mention. I've combined the results for the two systems, and we'll talk to that. If you want to see the detail for each of the systems, that's in the appendix. But the story is much the same for the two systems. So in order to keep things concise, we combine the results. So the foundation of any valuation is the membership of the plans. And since the systems have been closed, meaning that there's no new employees that are entering the system, as you would expect, the population is declining. In particular, the active population is declining the fastest. So again, we only have 14 active members, and the total population over the past 2 years has declined from 1,057 to 1,023. Not a precipitous decline in the total population, but the active population is decreasing more quickly. Any questions on the data? Okay. On the next page, we like to look at a history of the cash flows. And we started doing this a number of years ago before the pension obligation bond really improved the funding of the plan. At that time, the amount of assets was much lower than the value of the liabilities, and the benefit payments were causing a significant strain on not only the assets but the funded status. That's changed over time, but the benefit payments are still very large, relatively large in comparison to the city. So what I typically point out on this slide is even when there are positive investment returns, it doesn't necessarily mean that the asset value will improve or that you'll have positive cash flows. So you can see every year we're expecting about $30 to $31 million in benefit payments. So that's a pretty high bar for the investments to clear. So you combine the contributions plus the investments, that will yield, or we're looking for that to yield a positive cash flow, but it takes a pretty strong return. Even in years where the returns are strong, you're not necessarily going to have that positive cash flow. 2 years, the last 2 years will really elucidate that point. In 2021, we had some really, really strong returns. Even in 2020, we had positive returns, but the net cash flow was still negative. 2021, very strong returns, positive cash flow. So in a year like we just finished, the July 1, 2021 to June 30, 2022, where the investment return was negative, we're obviously going to see a negative cash flow. Questions, comments?
In that even if we achieve our 7.25% return, that's still going to generate a negative cash flow. But as time goes on, the liability in terms of the absolute sort of deficit is still declining.
That's correct. So the one thing we do know is that the liability is going to decline, right? Folks are going to receive fewer and fewer benefits as they age, and there are no participants coming into the plan. That, in addition with the contributions that the city is making, that should close the shortfall, create a smaller unfunded liability, such that the benefit payments aren't as significant in relation to the size of the assets. And hopefully it will be a routine event to see positive cash flows. And we expect that to be the case within the next 5 to 6 years. On page 12, we talked about the difference between the market value and the actuarial value. The one thing I always look at is how the market value relates to the actuarial value. When the market value exceeds the actuarial value, like it did as of June 30, 2021, that means over the past 5 years, the investments have outperformed our expectation over that 5-year period, that's 7.25%. When the actuarial value of assets exceeds the market value, that means over those past 5 years, investments have underperformed our expectations. So in 2021, we're coming off of a really banner year. That was the case for that 5-year period with the market value trailing or exceeding the actuarial value. This year, you bake in those numbers that we saw over the 12-month period ending June 30, 2022. As you would expect, the actuarial value is exceeding the market value, but it's doing exactly what we want. The reason we use that actuarial value is so that it's a smoother pattern of that we can use for the, or a smooth number that we can use for determining the actuarially determined contribution and creating a more predictable pattern of contribution. So despite those poor returns in the year ending June 30, 2022, the contributions, as we'll see in a few slides, has not increased significantly.
And I think that's important to point out that you've got two sets of lenses here. We're looking at these numbers, and for budgeting, we want to make our contributions so the system will be able to satisfy its requirements. But if you had a spike of $3 or $4 million one way or the other each year, it would be very tough on the city's budgeting process, and setting tax rates and so forth.
Exactly, and that's the whole idea behind using the actuarial value of assets. I think most cities, states, and corporations that we work with use an actuarial value of assets just so that they can more properly budget those cash outlays. On slide 13, we're comparing the actuarial value of assets to the actuarial accrued liability. So this is that funded status, the percentage of liabilities that the assets covers. And you can see very consistent over the past 2 years, 75%. And that's a direct result of using the actuarial value of assets. All the losses that we saw over the past year, only a portion of that is recognized, and we're deferring the remainder for the next 4 years. And telling, I included in the footnote what the return on the actuarial value of assets has been over the past year, where we had a negative 15% return on the market value of assets. The return on the actuarial value of assets is 6.3%, so much closer, much more in line with the actuarial expectation of 7.25%. The next slide presents the funded status, the health of the plan, using two different measures. The funded status, which is the percentage, as well as the unfunded liability, which is the dollar amount by which the liabilities exceed the assets. And I always give this analogy. the percentage can be somewhat deceiving. You can have $100 million in assets and $200 million in liabilities, and your funded percentage is 50%. The same thing if you had $1 of assets and $2 of liabilities. So you really want to take a look at the actual dollar amount to really measure the health of the system. Again, this does use the actuarial value, so it's the smooth value, but you can see that the unfunded liabilities improved quite significantly over the past couple of years on the actuarial value basis, from an unfunded liability of just over $90 million to an unfunded liability in 2022 of just over 70 or just under $72 million. Again, on an actuarial value basis. On the next slide, we're going to take a look at what that unfunded liability is in real terms on the market value and how it's changed over the past year. On a combined basis, as of June 30, 2021, the unfunded liability was $42.4 million with a funded status or funded percentage of 85.7%. This table shows all of the key inputs that reconcile to where we are as of June 30, 2022. So the interest cost is the economic growth of the liabilities as time passes. There's growth in those liabilities just due to that passage of time. The benefit accruals, the present value of benefits that are being earned by active members of the plan, very small, only 14 members. And then the benefit payments, just under $29 million. That's always going to be a significant draw on both the assets as well as the liabilities. So certain aspects of, or certain components of this reconciliation only affect the liabilities. Other aspects only affect the assets. The benefit payments is one that affects both the assets and the liabilities. Contributions that were made by the city, just under $11 million across the systems. And then the big number, the number that's really going to move the needle on an annual basis, is the investment return. Like I said, we kind of know what the liabilities are going to do within a very small margin. The investment return is really going to drive the funded status year to year, quarter to quarter. So we had a negative $39 million return over the past year. We've also shown a liability gain. That's really just it's actually a loss this year. That's the difference between what we expected the liabilities to be looking a year out and what they actually were, based on all of those assumptions that we talked about. Did members retire as we anticipated, terminate when we anticipated, pass away when they anticipated? If they terminate, die, retire differently than we anticipate, which is going to be the case, we're going to have a small either positive or negative impact on the liabilities, and that's what that $1.5 million liability loss represents. And then the investment and administrative fees that are paid to John Hancock and Greystone are also factored in here on the asset side. So take all of that into account from June 30, 2021 to June 30, 2022. The unfunded liability grew to $93 million. The funded percent declined to 68% from 85%. Thoughts or questions on the annual reconciliation?
I have a comment that, talking about longevity, I know that the city has taken the position in the recent years to have our funded percentages much greater than they were 20, 25 years ago. And I say that's a great stance, that they showed the concern for the solvability of it and stayed right around 70%. So that's something that's very notable to me. The other thing I have, when you blended the two plans, the group that I say I represent, active and retired, and they come back to me for discussions after these meetings, I think it would be much clearer if we went back to separating the two.
It's in there.
Okay, because the blending.
It's in the back, police and fire separated out.
And we can
Okay.
certainly go through that individually if you like.
As long as I've got it in print, then I'll be
Yep.
okay.
Yeah.
Yeah, it's in the
Make sure you
appendix.
go back there
Okay.
and use that.
All of my commentary applies equally to the fire and police as well as the supplemental system. If there are any
But the
items
plans are so different. The benefits are calculated much, much different.
yes, that is
And
absolutely
the two groups really don't want to sit and talk about each other, if that makes sense.
understood.
And there's a wide gap, and I'm careful of how I present that, you know what I'm saying?
Okay, and, but the numbers are roughly the same, even when you split them out, but they are there. So,
Tell me what.
page 24, I would go to. And it starts on 20.
Starting on 21, you can see the results broken out for the fire and police system. The same information that was presented in aggregate is detailed starting on 21 from the membership, the assets, the liabilities, the cash flows. It's all starting
That answers my
with
question.
page 21. Great. And to your point about the longevity of the plan and where it's come from and where it is now, if we can just skip forward to slide 17 and you can see how far the systems have come. We'll come back to slide 16 in a moment, but just to have that long-term perspective. Back in 2012, prior to the obligation bond and the additional funding going into the plan, the systems were only 31% funded.
And that caused great concern.
Absolutely.
I mean, it was very, very, very noticeable. I mean, there's a lot of rumbling about that, and then I give credit to the council for recognizing that and bringing it back up.
And it was a good financial decision. In the long run, it's going to cost the city much less through that obligation bond than it would have just to make the normal contributions that would have been otherwise.
Coupon on that bond is probably good if you think about what you would have to pay today if you issued a bond.
Yeah,
Absolutely.
I'm trying to remember, I had that number, what's left is around 3%, I think, 3%, less than 3% rate.
Yeah, now you can take money and put it in a treasury and make more than that.
Yeah.
So turning back to 16, I usually provide you via email with a quarterly update of the funded status. So I'll present that now to bring us up to June 30, 2022. Similar inputs as we had on the previous slide on an annual basis. This is just for the quarter. So the funded status, based on the challenging market that we're in, has further declined from 68% to just over 62%. That translates into an unfunded liability of $108 million versus $8 million at the beginning of the quarter.
I like this reconciliation slide on the one that.
Yeah, where'd that come from?
But I don't like. But I don't like
We
seeing
don't like
this
what we're
page.
seeing,
No.
yeah. But
It's hard to
good
look at
information.
some of these slides.
Well, we're fully expecting by the end of December that things will look better than this.
October was a good month. October stock market was up 8%, 8 or 9%. Bond market was down 1.5%, but October was a good month. And we'll see how the rest of November shakes out.
But, yeah.
And the next page, or slide 18, actually, we get to the less bad part of the presentation, all right? So when you're looking at the measurables of assets in comparison with liabilities, things might not appear so rosy, but the actuarial value of assets, like I mentioned, is doing exactly what we hoped it to do. The contribution, the actuarially determined contribution for 2021 was $7.8 million. The actuarially determined contribution, what I'm recommending for the city to put into the systems, is $7.8 million for 2022. So that's the less bad portion of this presentation, despite all the volatility and less than good news in the market. The contribution recommendation is in line with what we expected, in line with what it was last year. Fast forwarding to what we expect beyond this year, On the next slide, we did a projection of all of the key measurables from the assets, the liabilities, the funded status, and maybe most importantly, the contribution. And as a result of the recent performance of the market, we are anticipating in future years the contribution increasing. Like we said, it was just $7.9 million for 2022. We're anticipating in 2023 it'll be $8.6 million, all things being equal, and then leveling off in 2026 at about $11.5 million. So we do anticipate some increases in the contribution requirements as the recent losses get recognized in the asset values, driving a higher contribution. Thoughts or questions? That's really the end of my prepared remarks, but happy to take any questions, comments.
It's always interesting to hear it, and you pick up more perspective each time we do one of these.
I appreciate hearing that.
The Virginia retirement system, they just give you the number. They don't, they don't go into any theory, calculations, methodology, so this is helpful, I think.
Good.
Andre.
Thank you.
And we're good. My plan was, so there's additional information. The plan for today was to just have it as a leave behind, but
Okay.
there wasn't a lot of activity from a participant standpoint over the last 3 months. I think there was only 1 or 2 new benefits that were started and a handful of folks coming out of the system, unfortunately, due to passing away, but very low activity.
Well,
Might be interested in that information.
Yeah, I'm going to.
we're only 2 minutes past 10.
Pretty good.
That's good.
So we started out a little behind, but caught up. Thanks for Andre and Brian for going a little bit quick through those materials.
Can I ask a procedural question?
Sure.
Or maybe I should ask you later. What does John Hancock do if they don't hear from a participant, or they, I mean, it's hard, like we get return mail all the time from when the retirees retire. So what is your procedure as far as if you don't hear from someone for 3 to 6 months?
Yeah, so if they're in pay, I mean, if we see uncashed payments, we will stop them. And we will take extra steps to try to find lost participants. We also do what we call a death audit on an annual basis, just to make sure and determine if someone has passed away and it wasn't reported back to us, so that payments don't continue to be sent.
So how does that death audit work?
How do you mean?
Well, because recently we had one where the widow did not, the money was being directly deposited into her account.
Yeah.
The widow did not know that she wasn't privy, or she wasn't financially savvy to understand what was going into her account. And then it turned out that she owed the city a lot of money.
Yeah.
So, I mean, and it was over a year's period. It was more than a year.
Okay.
So I'm trying to avoid this in the future because, everybody thinks it affects my work, so.
Sure.
How can we not let it affect my work?
Yeah.
So what is your death audit process or procedure? Do you know?
I don't know all the specifics to it, but we can certainly follow up and have a conversation to go through it. But that situation you mentioned shouldn't happen. Typically we would not see that. There could be some gaps where a few months go by, but again, it's done at least annually to make sure that those potential long-term payments don't happen.
Okay.
But I can set something up and we can bring Tracy in and she can talk through all the specifics on it.
I may be able to offer something there. First of all, completely staying out of the business end of it. We would not want to know anybody's personal business, but we're such a small department and we are still tightly networked that if you've got someone you need to locate, we can many times find them.
So he'd be a good resource.
I mean, typically, we don't run into many problems because most folks want to know, to make sure we know where they are so that they're going to receive their benefits. But we do have procedures in place to find people.
We reach out to, if we lose a member, we reach out to the survivor to make sure they know who to contact and such as that, so we stay closely in touch.
Might be good to let Kathy know as well, just.
It
so-
wasn't someone within your realm,
but-
Okay.
but
So-
yeah, still, yeah.
I'll follow. We'll set some time.
I did want to remind everyone, the next quarterly meeting is February 9th, and we'll have our election then. But because so many people didn't come, I'm just wondering if this time or day of the week is good for everybody. So I'm going to send out something to ask, what works for everybody better. Maybe in your case, you might have a job obligation or something that you can't get here, or some other obligation. So stay tuned for that. And if it doesn't matter to you, tell me that too.
And we're certainly flexible. I mean, maybe there is some opportunity where we could suggest some other alternatives if it helps you, but.
Yeah, like in the afternoon, maybe you could not have to stay overnight, I don't know.
I don't mind coming down, contribute to the economy a little.
We appreciate that.
That's right.
All right, with that, meeting adjourned.
Thank you.
Thank you.